Hello and welcome to Scrushy on Business. I'm Richard Scrushy. We've got a lot to talk about today. I don't have time. I know I've said I was going to go over some questions, and we have got questions coming in, but I'm going to put them off to next week because it's got some really important stuff we've got to talk about. You don't want to miss this show. Let me tell you, here's my title. Private equity is killing American brands. Private equity is killing American brands. And then that's first segment. Second segment, the 2026 IPO boom is a trap for retail investors. That's what we're going to talk about today. We're going to talk about the big picture and what's going on right now in business in America. So you want to stay tuned through this. Remember, sponsor, Brothers Cleaner. I'm not going to talk about it, don't have time, but it's the best there is in the market. We'll talk later about Brothers Cleaner. They sponsor this show, and we're very proud to have them. So let's talk about it. Private equity is killing American brands. What are we talking about? Well, people understand that there's been a lot of buyouts of firms. I mean, different companies have been bought, like Denny's were bought by private equity firms. You know what? So what's happened? So when a private equity firm buys a company like Denny's, they load up a bunch of debt on it. Okay, and then when they put the debt on it, and then interest rates go up. So now what happens is you got this debt. So now they have to slash costs in order to create profitability. So when they slash costs, they change the quality of what's going on. Now we went through COVID. People are not dining quite as often as they are, and people are searching for cost-effective, dining opportunities. But let me tell you, what we're seeing right now is that the number of customers have shrunk. So here, add all this up. You got loaded up debt. You've slashed costs, you've decreased quality, and now you got a problem. So we're seeing right now, and that's private equity that comes in and does the leveraged buyouts. That's what we call a leveraged buyout. What does that mean? That means they leveraged it with debt. That's how they did it. So they would go in and look at a company, and I'm just going to make up some numbers real quick. They may say it would take $1 billion to buy, a national chain with a couple thousand locations. So what they do is they then go borrow the majority of that money. They might put in $100 million. They might put in $50 million as equity, but the majority of that money, I can tell you right now, is going to be debt. And when interest rates go up and the margins go down, the profitability is not there, those private equity firms, those investors they brought in, those big investors that bought all that now, they're saying, hey, you got to do something. You got to cut costs. Well, then they cut costs. Well, then the quality goes down. And I know many of you have been to places, restaurants, and different places that have gone through that. And you've experienced, that the service has gone to heck in a handbasket. And sometimes the quality of the product has gone down. Here's some firms that have fallen into that trap. Red Lobster, Denny's, Bar Louie, Hooters, Toys R Us. There are numerous newspapers all across America that have fallen into that. Hospitals, that's another one. We had a lot of problem with hospitals. And, And that's not a place you want to see quality of product go down because people get sick and they need good care. But that has happened. So the PE model treats an operating business like a financial instrument, not like a going concern. That's not how they think. They don't think about it like that. And they don't, and so like a going concern, not like a going concern that would actually hire people that would carry out the actual, services or the work or provide the products for that company. So, and they don't think about, private equity doesn't think about this business is serving a community. You put a Red Lobster or a Denny's there, they serve a community. My son and I, we used to love to go to Denny's. My son Jaden and I, we would go to Denny's, and we thought that was the greatest thing on a Saturday morning when we'd let her sleep in, and Jaden and I, we'd run down to Denny's, and we'd get us some eggs and bacon and whatever they had, pancakes, and it was always great. And we noticed deterioration in some of the services, and you just didn't have the same number of people, and things kind of went down, and even the same number of customers in there. So this is what happens. Now, here's what private equity says about this. They say private equity says, well, we employ millions of people. We manage trillions of dollars in retirement assets, okay? And they say, so attacking PE means you're attacking pension funds. You're attacking endowments. You're attacking 401ks that people invest in. Many and some people may have strong feelings about that. But what's happening is that with interest rates going up, and all that slashing takes place, it does deteriorate the product. So Also, here's another argument. Some people say, well, those brands were already going down, and when private equity came in and bought them, they were already going down. Yeah, but when private equity bought them, private equity should have been bringing them up, building a better foundation, improving the quality of what they were doing and services and all that, so that they would be able to make sure that the investment from those investors, from the fund managers, got a return on their money. So. And so that's kind of what they'll say. They say, well, there were already problems. So without these private equities, they're saying many of those companies would have died sooner. They would have gone out of business. They would have filed bankruptcy. They wouldn't have been around anyway. So that's kind of what they're saying. But let me give you a couple of data points. Red Lobster filed Chapter 11 in May of 2024. They emerged from it in December of 2024. And however, today in 2026, they're still closing. They closed 150 locations. They're down from 700 down to 550. Bar Louie is in their second bankruptcy. And I mean, I've been to Bar Louie. We had one here in the Woodlands. I thought it was a great place. And so, they've now loaded them up. They've got plenty of debt. Denny sold to a PE firm, same store sales down now, right at 3%. And of course, in February of this year, the CEO left the company. So, and here's the plan. Here's the projection in the restaurant business. It's not good, folks. I'm telling you, it's not good. It's 15% of all U.S. restaurants are expected to close in 2026. Some people say, hey, it's a good thing, because let me tell you, some of those restaurants are barely operating. The profits are thin, or they don't have a profit at all, and the services are not good, and they've just been hanging on, and they need to close. And when they do, the other restaurants will strengthen up, and they will become more profitable. The ones that are less likely to be able to continue to provide services or get customers in, because whatever they're doing is not necessarily really successful. So there's been a big argument on that. But here's the other thing that's been said, is that the 2026 IPO boom is a trap for retail investors. This is what they're saying. Now let's just look at what's going on here. This company, Cerebra, did a $3.5 billion IPO. Fervo, $1.3 billion. Now SpaceX is rumored to be $1 trillion and $250 billion. Can you just imagine that? I mean, that's bigger than many countries in the world. I mean, this one company that Elon Musk will have. And here's the problem. These evaluations, and these, it's pre-revenue and pre-profit. Many of these companies are not even operating. They don't have the first. They don't have the first profit center. They're not making any money right now, and so retail investors, are providing liquidity for these venture capitalists and insiders, who got into a problem. They actually got part of the IPO money. So, there's a company recently that went out, a company called Mobile Medical, okay? On day one, when it went out, it cratered, okay? And it cratered, for number one, it was losing money. And sales were going down. And then number two, they're having a problem getting the product. And what they do, it's a medical company. They have a medical device, and they have a problem with CMS even paying for the service. So, what happened was it went out to raise this money. It came out on initial public offer, and then it started going down because the market started pricing into their stock price all of these things. And when they start pricing it in, and people are selling, they're getting out, and the new people coming in, they're not going to pay up here where these folks were. They start picking it up down here lower. So these problems end up into the price. So very interesting things going on. So just a couple of data points. First of all, this year we have had 121 IPOs, initial public offerings, 121. That's 7% above last year. And so that's filing. Let's see, but yet so far 46 of them have been priced. 18 IPOs in April, $1.3 billion. It's busiest month since November of 2021. Thought I would just share that with you. That's kind of an interesting thing. So it go busiest month since 2021. Let's see, what month was that in 2021? You know, when you look back on that, November, busiest month since November of 2021. So something is going on. You know, I mean, there are some IPOs, but it's not what has happened in the past in terms of the kinds of companies. So let me give you an example of what I'm talking about. Okay, zero. I mean zero, meaning naught, meaning none. There have been no enterprise software companies filing for IPOs in 2026. And if you go back over the last 5-10 years, I mean, software companies were skyrocketing, and you saw them coming out all the time. And every industry in the world that we have that's of any size has to run on some kind of software. So you had all these software companies. We don't have that now, and that's not really a coincidence, folks. See, investors are terrified that AI agents will replace the entire categories of different kinds of software. They're terrified about it. And you got to ask the question, why would you go out and spend a fortune on a software package on different things when AI can actually do many of those things and provide many of the tools, scheduling tools, CRMs, analytics, dashboards? AI can do all of that. So why would you go pay a lot of money to a software company to do something that you can have AI just build for you? And there are companies that are called software, as a service, SaaS companies. That's what they call them. And they had a lot of proprietary things. And the ones that have proprietary data moats, deep workflow integration, regulatory compliance requirements, they're going to be fine. Those will be fine. AI is a feature. It's totally not a replacement, okay? Salesforce, Workday, and ServiceNow, they're integrating AI into their software platform, and those will be done. So they're not being replaced by it. So a lot of the companies, SaaS companies, those that are software as a service, they're integrating the AI in, and taking many of the elements that they were providing, and it's making it better, y'all. It's making it better. It's making it quicker. It's making it smarter. So there's a lot of good things going on. Now back to something real quick. There are many people that are saying that the restaurant industry collapse that we're seeing is actually good. Remember, they're saying projecting 15% of all restaurants are going to close over the next year. Come on, guys. I mean, 15%. I mean, you think about that. All the ones in your neighborhood, in your town, in your area where you live, in your state. So this supposedly, some people saying this is not a tragedy that it sounds like, and they're saying that it was long overdue. It's a positive correction. Sometimes we see industries correct. It just happens. We've seen, we've seen car different types of automobiles, brands that went away because they weren't needed anymore. They shut it down. They quit making them. I mean, you can't even buy cars that were with those names anymore. So, but there's sometimes it just takes that. It's actually a good thing when you start to clean up and you take out some of the businesses, let's just call it that are lingering and that are not very profitable. You take them out and the others get stronger. So that's what we're looking at. There are too many mediocre chains, they're saying. Too many mediocre food chains, restaurant chains that were kept alive, by cheap debt and cheap labor. And of course, they're saying the survivors will be better businesses, and they'll be able to pay workers more, and they'll serve better food, and So the comment is creative destruction. They call it creative destruction. In fact, sometimes is how capitalism just works. That's just the way it is. Now, millions of jobs are going to be lost when those 15% of those restaurants close, and some of the other restaurants will be able to pick up some of those people. Like I said, my family had business and restaurant chain, and they had a hard time hiring people. I mean, finding qualified people is difficult in the restaurant business. I mean, people that really can come in, that are smart and that understand customer service. I tell you what, I saw it all the time. They hired people, and those people just would not live up to the standard that my sons wanted in their restaurant chain. They would cut corners. I would come in and I would see when they were shipping things out, it just was not being packaged right. Matter of fact, I had one of our vendors that sells us products that sold the business product told me, says, "You come by my office, I want to show you something." And I went by there, and they had some of our product they'd bought, and they said, "Look at this. We want you to look at how this was presented to us when we bought it." And I looked at the packaging and the way that they did it, and I was just embarrassed. And I said, I had no idea. So I went over there and I talked to my sons, and they didn't have any idea. And so they were trying to train people on what to do. But anytime you turn your back, anytime they walked out the door, if they were not there looking over everything, the quality just went to heck in a handbasket. And I think that happens in a lot of businesses when the owners walk out, small businesses, that is. I think you see that. So, there'll be a lot of workers when they close all those Denny's. There are a lot of people that are going to be out of jobs, and where are they going to go? I mean, hopefully they'll be able to. The good ones will be able to go into the ones that are having to hire mediocre people, and they'll be able to increase the quality of their staff. That's what I hope happens, and there's a high probability that it could. Now, it's a fact that, you look at what Amazon is doing to retail business. I mean, come on. I mean, sometimes I'll find Amazon delivering to my house sometime 3 or 4 days a week. And I'm like, what is this? Well, then I look at what they delivered, and it's something that didn't cost but $11. And I'm thinking, well, how in the world can Amazon have a truck drive out here and drop that off? Well, they're driving up and down my street, dropping stuff off with everybody else. So I think it's just because it's volume. I mean, it probably didn't cost that much for them. They were on my street anyway. So in Amazon, when they came in, they didn't drop off at one location. They were dropping all over the neighborhood. So I guess that's how it works. But I tell you, in the restaurant business, DoorDash and Grubhub literally destroys, and especially in the pizza business, because in the pizza business, pizza companies, my sons, they had their own delivery operation. And I remember when the height of their business that they had 10 delivery drivers on a Friday night and a Saturday night. And they would do, well over 100 deliveries, maybe 120, 150 deliveries in a given night. So in the area that their store in the Woodlands was located, the Woodlands, Texas, they would drive, they would serve about an 8 mile, maybe a 10 mile radius, and making 100 deliveries would take, several hours. It was a lot. And if a delivery guy made 10 deliveries, he'd have a pretty good night because they paid him minimum wage. Plus they paid them, plus they were getting the tips. And I mean, people would give them pretty good tips. They'd have some big orders and, make 10 deliveries and your tips range anywhere from $5 to $20. You can do pretty good in a given night. And I saw many times they would make $200 a night in delivery. So it wasn't that bad for a part-time job to come in and do that. But when Grubhub came in and took the quality out, and DoorDash took the quality, they took the delivery out, they took the personal touch from the company out, and they took a part of the profit because they have to be paid. A lot of people don't realize this, but Grubhub, they had the hardest time trying to figure out, what Grubhub owed them. I mean, Grubhub, you got all this Grubhub food going out, and you realize it's 30-40% of your business, and you don't get a check, you don't get paid. Now, see, we got paid on, credit cards and everything else. You get paid in cash, but Grubhub send you a check at the end of the month. So you had a cash flow problem. And then when you got the check, it didn't ever seem like it matched up with the product that you sold. So there was always a problem. And then trying to figure out and trying to tick and tie that to what went out the door and what they paid you. And it always seemed like less and DoorDash and there's a few other things that went on as well. I can't remember all the names of the services, but it was hard and it was very difficult. And then you start looking at it and say, well, look, we got a negative cash flow here because of Grubhub and DoorDash and because Oh, and the other thing, food prices went up when gasoline under President Biden. Those gas prices went up so high, and then we started getting a extra. They started getting extra charge from the delivery companies for gas. I mean, next thing you know, and then the price of chicken went through the roof to where the cost of a wing that you were selling, you sell a dozen wings or 10 wings or whatever, couldn't make any money because what they were paying to get the wings was more than what they were selling them for, and but they had to sell them because people wanted them, but people wouldn't pay what it really costs. So it just devastated them. Now this is a bad thing. So small businesses really have had a lot of trouble. And then the next thing comes up are these ESTI, the easy to sell, sell yourself, and the internet sales. So so a lot of things begin to change. People begin to use the internet to buy. So a lot of these stores that were providing things. I mean, think about it. Even people are now buying their shoes online. They're not even going to a shoe store. I mean, so much has changed. When you go to shopping somewhere, it's almost so you could get out of the house and go do something, unless you got some special event and you want to buy something special. But most things, or you got to go get it fitted, or you want to try it on and make sure it works. Other than that, you're going to get it on the internet. And so much has changed. But anyways, we've seen a lot going on here. And the thing that's so sad about it is that it is going to be difficult for a lot of people. A lot of people that had depended on those jobs and working in those particular places. But I want to say something else to you. There's some of the companies that are going public. This company, X Energy, I'll bring that up. I was looking at X Energy. That's a company that's going out, and X Energy will have a huge valuation. And I went to reading about X Energy, and I read about it. It says here that they haven't built anything. Their pre-IPO funding is $1.4 billion. Now get this. No XE100. They make reactors. They have never built one yet. You hear that? They've never built one yet. They went out there, 1.4 billion. Okay? 1.4 billion, and net to the company 1.02 or whatever. Anyways, bottom line is they've never built what it is they're selling. Okay? So these investors come in at a pretty good risk. And there's an argument. There's a pretty good argument about that, but they're, Amazon and Tesla, when they went public, they were losing money. And so some people say, well, maybe the SEC ought to say they got to be profitable. If you're going to go out and sell it to the public, you got to be profitable. And then on the other hand, people say, well, wait a minute. These grown men and grown women buying here. These are adults. They can look at it and make a decision whether or not they think it's ever going to be profitable, and whether or not they want to put money in it. But also, you got to think about this. What is the possibility that a Tesla, if there was a rule that said you couldn't invest in a company unless it was making a profit, well, that would be a horrible thing, because Tesla would have never even been a company, wouldn't have been able to raise the money, and neither would Amazon, because they were losing money at the time they went out. But all your biologic companies and pharmaceutical companies, they got the same problem. They're all losing money. When they go out, they have to raise money to pay for the research and everything else. And then at some point, they're going to flip into profitability. They're going to turn to profitability. They're going to start making money. So if we had a rule that said that you couldn't put money, you couldn't raise capital in the public markets unless you were profitable, that would eliminate a lot of great businesses. So you really don't want to go there with that. But it is something to think about, that we value these companies at this huge valuation, and they've never done one lick of business. No, not a dollar. They got $1 billion plus valuation. Come on. Y'all got to think that's funny. I do. But anyways, it's real. And they've got some plans, and they believe that they're going to be successful, but they just haven't done it. So, anyways, a lot of important questions you got to ask when you're looking at investing in something that's never been built. Like, who is? And look, there are a lot of companies out there that raise the money and they never did build what they said they were going to build, and those people lost all their money. Okay, and of course that the plaintiff folks have a heyday on that. Let's go back real quick to the restaurant closures. I want to talk about those because I want to put a few things on the record. So we talked about it the other day, but Smoky Bones, Chapter 11, Hooters, Chapter 11, Carl's Jr., Chapter 11, Domino's franchises, Chapter 11, Domino's. Who would have thought pizza business? My. See, now that just tells me something because my son's had a pizza chain. And when, same thing, when by the time Grubhub and DoorDash got a hold of them, they couldn't make any money. You couldn't, and when they lost their own deliveries people, because now they got down to they only needed one or two delivery people on a Friday night because DoorDash and Grubhub was picking it all up. Oh, here was the other problem. I got to tell you this real quick. These Grubhub folks would come in and they didn't even have a hot box, and I'd ask them when I was down there with my sons helping them because I used to go down there and help them all the time because I loved to eat the pizza and they would let me eat pizza free if I would help them. So I'd be down there on Friday night, and I'd get in back, and I'd help, and I'd see these Grubhub guys come in, and I'd say, whoa, wait a minute. You're taking that pizza out. I've looked at that, and that's 10 miles. You're going to drive 10 miles for that pizza and not in a hot box. And I said, by the time you get there, that's not going to be a hot pizza. It's going to be a cold pizza. I said, where's your hot box? And I know that Grubhub gives them a hot box. Oh, I left it at home. I couldn't find it. It was in my closet. This and that. And I said, well, you need to go get it. So I just took it on my own. I called Grubhub and I said, these people coming in here do not have hot boxes. And I don't want to send my pizzas. We don't want to send our pizzas out to go over here 10-mile run and then we get a complaint. Well, you know what happened? We got the complaints. So the next day on Yep, what do you see? You see a 1-star rating on our. Try to get rid of a 1-star rating. You got to have 10 5-star ratings to make a 1 go away. And so it wasn't even our fault. And they said, well, pizza came, it was cold. Well, yeah, because the guy didn't have a hot box, but it wasn't us. And so now you lose that customer. And so over a period of time, you're losing customers every night. Eventually, you're not getting as many good customers as you're losing, and then your revenue starts to go down. It's just a serious problem, y'all. But anyways, here's another one. Domino's, we said, okay? Popeyes, can you believe that? Chapter 11, 801 Restaurant Group, Chapter 11, Bar Louie, Chapter 11, On the Border, Chapter 11. I think I saw the other day where Papa's in Houston's bought the chain On the Border, but anyways, I think they have been bought. They had 40 locations. It was a good company. They had a severe liquidity crisis, plus really high, get this, high lease, high labor, and high food costs. Okay, so they closed 40 locations. They got 60 open still. Let's see, looking up a couple of these others here. Okay, so I was just looking. So Hooters plans to sell all company-owned restaurants to franchise groups. Dozens of locations are already closed. Why? Rising food and labor cost is what's cited. I'm talking about all this on this podcast, and we normally talk about building businesses and funding businesses and all. But if you're thinking about getting in the restaurant business, you need to be listening to this because this is what's going on in the restaurant business. Bar Louie, we said that's a gastro bar chain, filed for bankruptcy a second time. They're down to 39 locations. That was a good business. Red Lobster, that's one. I loved Red Lobster, and I'm just so sad about it. Our Red Lobster closed that were close to us. Chapter 11, they emerged from bankruptcy but continued closing locations in 26, again from 7 to 550. TGI Fridays, they filed due to structure failures. Fewer than 100 U.S. locations remain. There was a time when TGI Fridays was one of the best in the business. And I don't know all the background on that, but I can tell you they were good. 30 more closures in 26. They're focusing on global expansion. Global, I guess, getting that to 1,000. I guess they're talking about around the world. One thing that really impressed me about TGI Fridays, I got to tell you this. There was a TGI Fridays when our offices were in Birmingham on Perimeter Park Drive. They opened up a TGI Fridays, which was we could walk to, and it was just right across the parking lot from our offices. And so they were having a grand opening, actually training. They were training all their staff, and we got invited to go down there and eat free one day while they were training because they had to get everything ready for the grand opening. And while I was there, I got to talking to some of the people, and they said that they had a rule that when you came in and you sat down at the table as a customer, they had to have water on your table within 2 minutes. That was a requirement. Somebody had to be at your table and they had to have water at your table. 2 minutes max. And usually it was less than that. And so I would watch in the training. I was watching how well everybody was doing. They had great management. They had great leadership, great trainers in there teaching them. And for several years, I went to that restaurant and ate there multiple times a week. And, I had certain things that I really liked. Food quality was off the chain. It was fantastic. Service was fantastic. The management was great. And we just loved TGI Fridays forever. And then I came out here to Houston, and there was a TGI Fridays that was close to the mall. Matter of fact, it was on the mall loop. It goes around the mall in the Woodlands. And I went into that TGI Fridays, and I ordered the same meal that I used to love to get at the one in Birmingham. And it was not good, y'all. I hate it. It wasn't the same quality. And I was very, very sad that it happened. But I could see the deterioration. I could tell that the facility needed to be renovated, needed to be cleaned up. And guess what? Wasn't long before it was closed, and they went out of business. So y'all understand that. We've seen it. Everybody's seen it. But here's another one. Wendy's. What about Wendy's? Wendy's closed plan, 300 to 350 locations closing. Mm-hmm. Yep. Pizza Hut. See, back to the pizzas. Same thing. 250 locations are closing. I got to tell you this. I'm going to wrap this up with this report. We've got a lot more to talk about in the next couple of weeks, but I wanted to hit you with all this today. Papa John's, here's another pizza place, 300 locations laying off. I'm telling y'all right now, when those pizza places were delivering their own pizzas and they were in hot boxes and they got to those families hot, tasting great, with good service, the business was good. It was good. Now, you do have the cost that has gone up of cost of all the food and everything, and the cost of rent and all of that, but and the cost of salaries. I mean, think about California. They've increased the minimum wage. I do tell you this. When my sons were in the pizza business, and my daughter was going to Pepperdine, and she was living there in Malibu, we were out visiting my daughter, and there was a really nice retail place that was right next to a Starbucks, and it was available for rent. And of course, the rent that they were used to paying was about, $25 a square foot annually, right? So we went in and we just said, well, there was a number there for the real estate. And, we got that number and all. We looked at the space. It was great because my sons were thinking about putting one there. They needed one there, and I'm going to tell you why they needed it. But so contacted them. It was $110 a square foot, California, $110 a square foot versus $25 a square foot. Is what they were paying at the store in the Woodlands or the store they had in Katy, Texas, and so many of the others. But here's the thing. It was a great location. So we looked at what pizza prices were, and for the same large pizza that they were selling for $14.95, you're going to pay $35 for in Malibu. That's just, and I don't even know if it was as good. I didn't go order one because I thought it was way too expensive. So it's more than 50%. So people have to make more money out in California if they're going to eat pizza. It's just crazy, when you start looking at that. But Papa John's and Domino's and Pizza Hut, it's not good. And then again, Denny's closing 70 to 90, Noodles and Company 30 to 35, and then Outback Steakhouse, which we loved Outback, boy, when they first got going, everybody loved them. 40 plus locations. Why? Just declining business. Yep. They shortened the menus, sales recovering at some of the stores, but really a very difficult situation. Okay, chains closing entirely that are nearly gone. Let me hit these, and we're going to wrap it up today, and I appreciate you watching. Bahama Breeze closed almost all theirs. Boston Barket near extinction. Houlihan's shrinking rapidly. Long John Silver's declining steadily. They have closed so many stores. Joe's Crab Shack. I saw that one coming after I ate it, a couple of different ones, and I knew the quality had gone to heck in a handbasket. Iron Hill Brewery and Planta, which is a vegan chain. It closed abruptly, all 16 locations. I guess they didn't have enough vegans and vegans that out there, enough people that wanted to eat the vegetables and got off all the meat. So anyways, that one didn't do. But anyways, I want to thank y'all for watching us today. And we've had a good time. We covered some stuff. I mean, it's controversial what's going on, but, this whole thing with these private equity firms slashing costs, they leveraged them out. It's what an LBO is, LBO, leveraged buyout, and they put too much debt on them. They ended up, when they did that, and then they had to slash costs, then they ended up slashing quality. And when they did that, it started on a declining downhill situation. So these funds get, they should have given them time. They have to give them time. They have to straighten them out. They have to clean them up. They have to rebuild them. They need leadership in there. The leadership, motivate the people. Do a better job. Create a reason for people to come back. The other day I talked about it. I said, you got to have something 10 times greater than your competitor to draw people in. The restaurant my wife and I go to, and we love it in the Woodlands, they've got something there that is 10 times better than any other restaurant in the area. That's why we go there. Okay? Listen, y'all have a great day. Remember, Brothers, it's a great product. Multi-cleaner, you want this. I'm telling you, if you don't have this, you're going to wish you did. So for this week, you go to brotherscleaner.com. And this is not good for a long time, y'all, but for the next week or so, I'm not sure the exact cutoff date, but if you get on it right now, you order one of these, it's $15.99, you get one for $1. So you'd get two for $16.99. And they ain't making any money on that, y'all. That's a promotion. It's a one-time deal. You need to jump on it. And keep in mind also, if you do order 4, one of them is free. Okay? Take care. Y'all have a blessed day. Thank you. Don't forget to hit the button and subscribe. We're on YouTube. We put out a new podcast episode every week, and we do appreciate you so much. Have a blessed day.